Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now let's get started with a brand new chapter called as marginal costing. So please take the heading chapter 12, right? Chapter 12, marginal costing. A very important chapter, not just from the perspective of your exams, but also from your real life perspective. Marginal costing is something that you will be using in your everyday life for your decisions, but without knowing the fact that this is all covered under marginal costing. That's about it, right? A very beautiful chapter. This chapter deals in and out about decision making and exam every attempt. There cannot be a paper that gets printed without concepts in marginal costing. Such a very important chapter, and this is also there in your CA final, in your self-paced modules. The advanced version of marginal costing is there. So here you see the basics. So without understanding the basics, you can't even enter into the advanced level of marginal costing in your CA final self-paced module, strategic cost management and performance evaluation, right? So that such is the importance of this chapter. So when you are learning it, please learn it with full concepts. Follow whatever instructions I'm giving. Catch up running notes. This is going to help you in the long run. Clear with this? And this chapter, many students mug it up by way of formulas, which is an absolute crime. No, no, I will prove it in front of you. There is not even a single formula to be mugged up. You can arrive at the formulas by yourself, right? That is the beauty of this chapter. Everything is conceptual, very simple and conceptual, provided right from the first word I utter. If you are following it carefully, automatically we will be building the subject beautifully, and we will be able to understand every single concept hidden inside this particular chapter. Clear with this, guys, right? So please have the full focus here, full attention here. Very important chapter from an examination perspective, as well as you can use it in your real, you can use it in your everyday lives as well. Clear with this, guys? Shall we get started? Shall we get started? Yes. So now, first, take down the learning objectives of this chapter. Now, the learning objectives, it is not given as such in your institute study material. I have compiled a very good set of sums from the study material and some sums from the outside past exam RTPs and all that. Based on that, I will be outlining the concepts that we are going to cover in this particular chapter. Clear with this? So this learning objectives, you cannot find it anywhere in the study material, but all these things are covered in the study material in a very scattered manner. So we are putting it in an organized way. Please write down learning objectives. Guys, there is a reason why I am making you write all these things. I could have easily printed and given it to you. The reason why I'm asking you to do all these things is your note taking should be such that tomorrow it should be a one-stop source of preparation for you. If you touch your notebook, you are sorted for life. That's about it, right? So now write down first write down income statement under marginal costing. Write it fully. Whatever I'm writing here, it is just for your reference in your notebook. Write it fully. Income statement under marginal costing. Then number two, profit volume ratio. Profit volume ratio within bracket PVR. We will be using this short form in our lectures, PVR, or people even call it as PV ratio. Third, break even point. Break even point within bracket BEP right? Hyphen in units and value. Break-even point can be expressed in units and in value. Write down hyphen in units and value. Right? Then fourth, margin of safety. Margin of safety within bracket MOS. MOS. Point number 5, profit. Point number 5, profit. Done? Done? Yes, write down. Point number 6, cash break-even point. Cash break-even point. Cash break-even point. Cash break-even point. Done? Right. Then write down number 7, indifference point. INDIFFERENCE. Indifference point. Indifference point. Then 8, shutdown point. Shut down point. Indifference point, the previous step, within bracket write down IDP. Indifference point, short form, we will call it as IDP. Not accepted short form, classroom discussion short form. Indifference point, write down IDP. Then shutdown point you have. Then number 9, volume analysis. All these volume analysis and all the sums are there in the study material, but you don't know that it is called as volume analysis, but it is there as such, right? So I am giving you a structure and giving it a name also, so that in your library of adjustments also we can write it accordingly. Clear with this? Then volume analysis is that. Write down sensitivity analysis. Sensitivity analysis. All these are beautiful concepts. Sensitivity analysis. So shutdown point, indifference point, volume analysis, sensitivity analysis. Write down number 11. Merger of plants. Merger of plants. PLANTS. Plant means a factory. Merger of plants. Then 12, sales mix and marginal costing. Sales mix and marginal costing. Sales mix and marginal costing. Done? Right. Then write down point number 13. Limiting factor. Limiting factor stroke key factor. Limiting factor stroke key factor. Actually, in this concept, there was one very good sum in the study material. It was even a past exam question. I don't know for what reason they have removed it from your latest study material. Don't think that it is not there. The concept is still there. They have removed that sum alone, but we will be doing it in the lecture. A very good sum to understand the concept of limiting factor, right? So don't think that many students are telling that just because they have removed that sum from the new syllabus study material, the concept itself is not there. Please don't believe all those things. They have mentioned the concept, only that some they have removed. So is it a rule that only the questions mentioned in the study material should be tested? Absolutely not of that sort. We are not doing any school exams here. This is a professional exam. If there is a concept mentioned in the study material, they can ask any kind of sums with respect to that. Clear with this. So don't think that this is out of syllabus and all. We will be doing every single thing, right? Then I think that's about it. No, right on. 14. Am I numbering it right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Yes. Write down marginal costing versus absorption costing. Marginal costing versus absorption costing. That's about it. Right? That's about it, guys. That's about it. So we've got these 14 concepts here in this particular chapter. Entire chapter applicable for your CA intermediate. I have broken it down into 14 concepts, right? Now, beautiful chapter. It's pretty big, no doubt, but it is going to be a lovely chapter. Just enjoy it. That's all I am asking you to do. Please enjoy it, right? And you can enjoy it only if you understand the subject conceptually. Clear with this, guys, right? So right from the word go, when I start the introduction itself, please be attentive, bring in your full focus. Even those students who are attending the lectures on the recorded mode, assume as if I'm standing in front of you and teaching. Participate. When you see the screen, you shout the answers, or if I'm asking you a question, you reply back. It's okay. That's when you get the best learning experience. Right, guys? Fine. So these are the 14 learning objectives that we will be seeing in this particular chapter. And okay, so take a blue ink and put a flower bracket across the first 5 concepts. Put a flower bracket across the first 5 concepts. So these first 5, I call it as the basics of marginal costing, right? So we will be spending more time here and we will be understanding. Once you set the foundation, the building can be built very strong. Clear with this. So these first 5 concepts put together, I call it as the basic concepts or the basics of marginal costing. Clear with this. So when we are doing this library of adjustments also, I will ask you to note down basics. Basics means I am referring to the first 5 concepts. Once you cement your understanding in these 5 concepts, slowly we will beautifully build the subjects and finish off all other areas as well. Right? No hurries. Be patient. And the students who are watching this on a recorded mode, please don't fast forward 1.25, 1.5, 2x and all. Don't do all of that. Please do not do all of that. Watch it in a normal speed. Even if you find it slow, it's okay. Please do it. Do it definitely for this chapter. Do not venture out all these things. It's a beautiful chapter. Let the chapter unfold in front of you. Clear with this, guys, right? So shall we get started? So we've got 14 learning objectives. So now let's get started. Shall we, guys? Yes? Yes. Right. Now, take the heading Basics of Marginal Costing. Basics of marginal costing. Now, guys, in our study, in our handbook, right, there are a lot of things explained there. Here, introduction and all these things. Fine. I think you can read it much better than me. I don't want to be a news reader and read all these things. Let's understand the subject practically in the way we understand, in the way we do it normally itself. We will purely understand the question, the entire subject. We will understand it conceptually and logically. and then when you read it, you will automatically understand all of that. With examples, illustrations, I will do. All these examples are not there in your institute study material also. They are not there in our handbook also. It is there only in our lecture, and I want you guys to note it down. Clear with this, guys? Fine. Now, marginal costing. What is this and all? First, let us take down an example, and with the help of this example, we will understand all the basic concepts involved in marginal costing. Clear with this? Every chapter has its own strategy. In fact, I would say inside a chapter also, every concept has a way of learning, right? This particular area, we will learn it by way of an example, and then we will see all the aspects that we are going to cover. Clear with this, guys? Else, if I say marginal costing, the word marginal means this, costing means this, there is no use at all. Clear with this, guys? Take down an illustration. Write down illustration. Illustration. Selling price per unit is equal to rupees 10. Variable cost per unit is equal to rupees 6. Fixed cost is equal to rupees 10,000. Sales volume is equal to 6,000 units. 6,000 units, right? This is the data available. What are they asking you? What are they asking you? A, prepare a marginal costing income statement. Marginal costing income statement. B, calculate PV ratio. C, calculate break even point. D, calculate margin of safety. And E, calculate profit. That is the first 5 learning objectives. Clear with this? With the help of this example, we will understand. No need to mug up even a single formula. We will understand it conceptually. I will also be giving you some practical examples. With that, we will get started. Clear with this, guys? Right? So this is the question. Selling price per unit is 10. Variable costs per unit is 6. Fixed cost in total is 10,000. The sales volume is 6,000 units. We need to prepare a marginal costing income statement. Calculate the PV ratio, the profit volume ratio, the break-even point, margin of safety, and the profit. Clear with this, guys? Right. Now, in the basic concepts, when we learned, I told you very clearly. Now, our subject has how many objectives? Come on, participate. How many objectives? 3 objectives. Objective A, stock valuation, profit computation. Objective B, decision making. Objective C, control. Right? Now, this chapter, marginal costing, deals with objective B, decision making. Clear with this? It deals with decision making. Hence, cost will be looked at from the perspective of variable cost and fixed cost. Are you clear with this? Cost should be looked at from the perspective of variable cost and fixed cost. Are you clear with this? So here in this chapter, the classification of manufacturing, administrative, selling and all is not at all required. Why? That is required only if you want to achieve stock valuation profit computation objective. Here I am talking exclusively about decision making. Hence, cost needs to be looked at from a perspective of variable cost and fixed cost. Are you clear with this? So this chapter achieves what objective? Decision making objective. This chapter achieves decision making objectives. Are you clear with this? Yes, guys. Now, in the last segment alone, that is this concept learning objective number 14, here alone we will be seeing stock valuation and profit computation objective. What it is, I will tell you separately. Till then, entire chapter is only going to be decision making. No second thoughts about it. Clear with this, guys. The last part alone, since we are comparing it with absorption costing, overheads absorption and all, so there we will be seeing stock valuation profit computation objective from the viewpoint of marginal costing and absorption costing. That's about it. All other areas, this chapter is a hardcore decision making area. Clear with this, guys. And hence, this chapter needs to be necessarily looked at from the perspective of variable cost and fixed cost. Are you clear with this? Now, we know, we have seen in the basic concepts that variable cost makes sense only if it is represented on a per unit level, whereas fixed cost makes sense only if it is represented in total. Correct? Variable costs means what? Only if I produce the next unit, I will be incurring the cost with respect to that unit. Else, if I don't produce the next unit, for that I need not incur the cost. A prime example will be material costs, right? Only if you produce one additional unit, you will have to consume material and we will be incurring the cost. If I don't produce that particular output, then I need not incur this extra material cost. Correct? Whereas fixed cost example is, I will say, factory rent. Whether I produce my products or not, whether I produce 1 unit or 10,000 units, or I don't produce anything at all, I need to pay my landlord this 10,000 rupees of rent. Are you clear with this? So that's why fixed cost makes sense only if it is represented in total, whereas variable cost makes sense only if it is represented on a per unit level. Are you clear with this? This is something that we have already seen. Place yourself, we are in a chapter that deals with decision making. Now, first, they have asked you to prepare something called as a marginal costing income statement. First, let's do that. Let's do that. I'll write down here solution. Write down a marginal costing income statement. Let us see how to prepare this marginal costing income statement. Yes, I have already told you a few things before, but still, let us do it afresh here. Now, this is how your marginal costing income statement looks like. Sales minus variable cost gives you contribution, and from that minus fixed cost gives you profit. Please write this down. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Right? Done? Noted down. Now, please do not write anything. Please do not write anything. You just, I hope you have written the format. Now, please listen to me. Please participate. I will give you time to write down everything. Please participate. Very important understanding. Now, I need to find out the profit. Correct? How will I calculate the profit? Simple. Total sales minus total cost. If I do, I will arrive at the profit. Correct or not? Yes? Fine. That is what we are doing here. Total cost is nothing but variable cost plus fixed cost. Correct? So from the sales, we are reducing variable cost. We are further reducing the fixed cost. That is, we have adjusted for the total cost. We are arriving at the profit. Clear with this, guys? Fine. Now, instead of presenting it as total sales minus total cost gives you profit, marginal costing income statement, what they say is, don't do it like this. From the sales, you reduce only the variable costs. Right? Right? Now, here if you see, every unit I sell, I am able to generate a revenue of how much? Hello? Come on, participate. Every unit I sell, what is the revenue, the selling price I am able to generate?
10 rupees.
10 rupees, correct? I have sold how many units? 6,000 units. So what will be my sales here? My sales will be 6,000 units into every unit gives me a sale of 10 rupees. Selling price of 10 rupees. You can write this down later. Fine. So here I get how much? A total of 60,000 rupees. Right? Similarly, what is the variable cost? Let us say the cost is, let us say material cost I am incurring predominantly. Every time I sell one unit, I am incurring a variable cost of how much? They have given 6 rupees, right? So 6,000 into rupees 6, that gives you how much? You incur a total of 36,000 rupees. Correct, guys? That is, every time I sell a product, I get 10 rupees. But for me to get this 10 rupees on a variable level, I incur how much? 6 rupees. Correct? So the net variable profit that I get is how much? 4 rupees for every unit being sold. So if I sell every unit, I get a variable profit of 4 rupees. Are you clear with this? Now you tell me, is this the final profit? No. Why? Because fixed cost is yet to be adjusted. Fixed cost is also a cost I incur. But on a per unit level, variable level, I can say, I earn every time I sell a product, I get 10 rupees. For that, I incur 6 rupees. The net variable profit I get is how much? 4 rupees for every unit sold. In this case, I have sold how many units? 6,000 units. 6,000 into 4, how much you get? It is going to be 24,000. Or you can even say that total sales minus total variable cost, 24,000. This 24,000, is that my final profit? No, it is the variable profit. We call it as contribution. Are you clear with this? Now, why do we call it as contribution? I will tell you, there is a logic for that also, but wait, right? This is called as contribution, nothing but variable profit. This is not your final profit. Now, from this, reduce your fixed cost. Fixed cost anyways is a cost incurred in bulk. How much is that? 10,000 rupees. 10,000 rupees. So now I have a profit of how much? I get a profit of 14,000 rupees. Are you clear with this? Are you clear with this? Yes. Now, sir, this is nothing but, what is my total cost? Total cost is variable cost 36,000 plus fixed cost 10,000. Totally, I have incurred how much? 46,000. I could have rather said 60,000 minus 46,000. What is my profit? The profit remains to be 14,000. Clear? The same profit only you get. Now, what do you get by presenting it in a certain format? This is something we will be seeing in this chapter, how it will help us and all. As we move to the next concept and all, PV ratio, break-even point and all these things, you will beautifully understand all this intricacies of this chapter. Are you clear with this? So so what is the format of cost sheet? Sales minus variable cost gives you variable profit, that is called as contribution. From that, you further reduce fixed cost, you get your profit. Are you clear with this? Now, sir, why is this called as contribution? Why is this called as contribution? Look at the beauty of marginal costing here. It says, every time I sell a unit, right, I get 10 rupees, for which I need to incur variable cost is 6 rupees. So the variable profit I generate is 4 rupees. Correct? Now I have sold 6,000 units. So right now I have accumulated a variable profit of how much? 24,000 rupees. Correct? Now, using this 24,000 rupees, first I try to recover whatever fixed cost I have incurred, right? And having recovered whatever fixed cost I have incurred, any amount that is left over, that goes on to contribute towards my profit. Are you clear with this? And hence the name contribution. It contributes towards recovery of fixed cost and then later towards generation of profit. Are you clear with this? And hence the word contribution. Guys, clear with this. Don't mug up anything. If someone asks you all these things in an interview question tomorrow, why is it called as contribution? You should be able to tell them it's nothing but a variable profit. They could have called it variable profit. No. Yes, but why are they using the word contribution? It first, with this variable profit, I try to recover whatever fixed cost I've incurred. This 24,000 rupees, I now got variable profit. Wait, that is not my final profit. With this, I try to recover whatever rent I have paid, fixed cost, and over and above that, whatever I have, that is the amount that I can enjoy for myself, called as your profit. Are you clear with this, guys? Are you clear with this? Are you clear with this? Please write this down. Please write this down. First, you just write this down. Now, whatever this calculation, the figures, you just write this down. Guys, trust me, this is going to be a lifetime learning for you, because from now on, there will be a lot of areas where we'll be seeing marginal costing. In final, also, we'll be seeing marginal costing. That's why I am taking it very slow. We will set the foundation very strong, and then whatever is the concept, you can derive it and arrive it by yourself at any given point of time. So make sure that you are getting the best learning experience, and there is no mugging up in this chapter. Mugging up is a crime. In costing itself, it's a crime, but marginal costing more so, definitely not acceptable, right? So please do it quickly, and then we will proceed. Done, guys? Done?
Yes.
Clear with this? Fine. So now, one more thing, in our subject costing, we only consider operating items. Do we consider non-operating items? No. The same thing applies in marginal costing also, right? So variable cost and fixed cost, though I am calling it as fixed cost and all here, fixed cost would be generally your production overheads, admin overheads, your selling overheads and all. At no point of time you will be having your finance costs. Those costs will not come here. It will not be considered in costing at all. Are you clear with this? All these are operating fixed costs incurred either in the factory or in the sales depot or in the corporate office, not not your financial costs. Are you clear with this? That's why whatever profit that you arrive here, this profit is actually nothing but operating profit, or to put it in financial terms, I will call this as EBIT, earnings before interest and tax. Are you clear with this, guys? Earnings before interest and tax. If you see in financial management, we would have learnt FM starts from EBIT. From EBIT, we reduce interest, arrive at EBT, minus tax, EAT, preference dividend, and all these things are there. So costing stops here, and from here only FM begins. So all your interest, finance charges, dividends and all are considered in financial management. Here when I say fixed cost, I only talk about fixed operating cost. Are you clear with this? Here we don't consider any kind of interest, finance charges and non-operating items. Are you all clear with this, guys? Yes. Are you all clear with this? Yes. Right? Fine. So this profit that we are reporting here in marginal costing is only operating profit, also popularly called as earnings before interest and taxes. Clear with this, guys? What happens after EBIT is a subject matter of discussion in financial management. Are you clear with this, guys? Have this clarity. Fine. Now, so first they have asked us to prepare marginal costing income statement. Have we prepared it? Yes. Right. So what is the marginal costing income statement? Come on, tell me once. Come on. Sales minus variable cost gives you something called as contribution, minus fixed cost gives you profit. Clear with this? When I say profit, I mean operating profit, also known as EBIT. Now write down B. They have asked for something called as profit volume ratio, PV ratio. Yes, popularly known as PVR. By the way, guys, PVR, you all know this PVR cinemas. Full form of PVR, you guys know? PVR stands for Priya Village Roadshows. That's how they started. Priya Village Roadshows. And today they are ruling the industry. So it started off very humble beginning. Now just see where they are. So it's all consistency and confidence that takes you forward. Anyways, passing reference. Right? Fine. So now, what have they asked next? They have asked us for the PV ratio. So now, what do you mean by PV ratio? Now, guys, you just concentrate. I will give you time to write down. Do not worry about it. Fine. Now, we saw that sales minus variable cost gives us what? Contribution. Correct? Gives us contribution. Now, you tell me, guys, I want you guys to participate. I will give you the time to write down. Now, when I sell every unit, what is the revenue I generate? Come on, 10 rupees, right? And when I sell every unit, how much variable cost will I be incurring? 6 rupees. So, every time I sell a unit, what is the variable profit I earn? Also known as contribution? 4 rupees. Yes. Traceable on a per unit level? Yes. Yes. Fine. Now, if I want to put it in total value, that is, in this example, we have sold how many units? 6,000 units, right? So, when I am selling 6,000 units, what will be my total sale value that I will get? 6,000 into 10. How much is that? 60,000, right? What will be the total variable cost I would have incurred? 6,000 into 6. It's going to be 36,000, right? So, what will be the total contribution that I would have earned? Not the final profit, it's the variable profit. So, 6,000 into 4, it's going to be 24,000. Are you clear with this? Are you clear with this? If you keep 10,000 units, again you can multiply respectively 1 lakh, 60,000, 40,000 and so on. Are you clear with this? Are you clear with this? And so on, you can do it. Or if I want to express this as a percentage, now let us keep the sale as the base, right? Can I say when my sale is 100, that is, when my sale is 10 rupees, my variable cost is 6 rupees. Or in other words, can I say variable cost is generally 60% of my sale, correct or not? Yes, variable costs, I am expressing it as a percentage of sale. It varies, no, along with my sales. So can I say variable cost is 60% of my sales, correct? Yes, guys. If variable cost is 60%, the balance 40% is only my contribution. So can I say my contribution expressed as a percentage of sale is 40%? Correct, guys? Are you clear with this? Are you clear with this? Now, this 60%, that is nothing but the variable cost expressed as a percentage of sale is called as variable cost ratio. This is called as variable cost ratio. What do you mean by variable cost ratio? Expressing my variable cost as a percentage of sale. How will you arrive at it? You can either do it on a per unit level and say 6 divided by 10, or you can do it on total level, 36,000 divided by 60,000. Whichever way you want, you do. This is also same. 36,000, how did you get? It is 6 into 6,000. Correct? 60,000, how did you get? 10 into 6,000. Correct? Anyways, this gets knocked off. Ideally, it's only 6 by 10. Are you clear with this? If I do this for 10,000 units, again, it's going to be numerator 10,000, denominator 10,000. So it doesn't, it is really not a big issue at all. So at any level, you take the variable cost and divide it by your sales, multiply it with 100, you get your variable cost ratio. Are you clear with this? Similarly, this 40% is there, no? It is called as profit volume ratio. Sir, why sir profit volume ratio? I told you this is nothing but variable profit only. Contribution is nothing but variable profit only, right? So profit for a given volume. So I cannot express this final profit as a percentage of sale because it will not move proportionately because of the presence of fixed cost in between. Only the contribution can move in proportion to my sales. Are you clear with this? Are you clear with this? Hence, this contribution expressed as a percentage of sale is known as profit volume ratio. Are you clear with this, guys? Are you clear with this? Are you clear with this? Or I can say VC ratio plus PV ratio will always be equal to 100%. Correct? No, that is nothing but total sale will be made up of variable cost and contribution. If I make sales worth 1 lakh rupees, I can say that 60,000 rupees is my variable cost, 40,000 rupees is my contribution. Correct, guys? Are you clear? Variable profit. Yes, are you clear with this? So when I'm expressing it as a percentage, variable cost ratio plus PV ratio, profit volume ratio will always be 100%. Guys, does it make sense? Does it make sense? Yes, suppose in a question they have mentioned the variable cost ratio is 60%. I can directly say that the PV ratio is 40%. Are you clear with this? Yes. Any problem here? Any problem here? Are you clear with this, guys? Please write this down. Please write this down. Please write this down. See, some students might be knowing all these things before. It's okay. Still write this down. Slow and steady wins the race. Now, having completed all these things, now you will know. Once we are doing the sums, we will go very fast because you yourself will do very fast. That is the power of conceptual learning. Spend this time here. Remember, I keep telling you this. Abraham Lincoln saying, give me 6 hours to chop down a tree. I will spend the first 4 hours sharpening the axe. So we are sharpening the axe right now. We are building the concept. Once that is done, sums will not take much time. That's about it. Come on, write this down. Fully, properly, neatly write this down. Generally, I ask you to do all the writing along with me, but this area, I always put a speed breaker and do it like this. So with this, you can also infer this. PV ratio is 100 minus VC ratio, or VC ratio is 100 minus PV ratio. These two are complementary. Correct, guys? See, all these things in the study material, they would have given this as 3 formulas and students also mug it up. This is not a formula, guys. This is definitely not a formula. I don't want you guys to remember this as formulas only. Put it in a statement format, you will automatically know. That's about it. There is not even a single formula that needs to be mugged up in marginal costing. Please don't fall for it. Right? Done? You guys are done here? Yes. Yes. Fine. So what do you mean by a PV ratio? Contribution divided by sales into 100. VC ratio, variable cost divided by sales into 100. You can either do it on a per unit level or you do it for any volume level. It will be the same. Percentage and all will not change. Clear with this, guys? Are you clear with this? Yes. Fine. Next. Write down C. They've asked for something called as break-even point. Write down, please write down. Break-even point, BEP is the point of sale. BEP is the point of sale where there is no profit, no loss. Where there is no profit, no loss. No profit, no loss. There is no profit, no loss. So what is BEP? What is BEP? It is a point of sale. It is a point of sale. It is a point of sale, which means how many units should I sell to arrive at a no profit, no loss? My final profit, not contribution. Final profit should be 0. It should not be in positive, it should not be negative. So it is a point of sale, and sale can be expressed in both volume as well as in rupee. Correct? No? In value. Yes, guys, I can say I'm selling 10,000 units, or I can say I'm making sales worth 1 lakh rupees. Correct? No? That is the reason why break-even point can be expressed both in your units as well as in value. Are you clear with this? Now, what is this? How do we arrive at it? Now, let me tell you this. Let me tell you, they have given all these formulas and all, it's not required. I will tell you logically how you can arrive at it. Now, Now, first, what is your marginal costing income statement? Sales minus variable cost gives you contribution minus fixed cost gives you profit. Right? Now we know that every time I sell a unit, I will get how much? 10 rupees. And every time I sell a unit, I will be incurring a variable cost of how much? 6 rupees. So my contribution every time I sell a unit, I will be generating a contribution of 4 rupees. Correct, guys? What is my fixed cost? My fixed cost in our question, it is 10,000 rupees. Correct? Now, what are they asking? What are they asking? The break-even point refers to what? The point of sale where my total profit is zero. That is, my profit is neither positive nor negative. Are you clear with this? No profit, no loss situation. Now, logically think and you tell me, guys, when will I be getting exactly a zero profit? I will be getting exactly a zero profit when I earn so much amount of contribution that is sufficient exactly to recover my fixed cost, right? I am not even earning 1 rupee beyond this 10,000. If I earn 1 rupee beyond this 10,000, then I will be having a profit scenario. If I am earning 1 rupee less than 10,000, I will be having a loss scenario. So, can I say break even point situation happens when my contribution exactly recovers my fixed cost? Yes, guys. It should not be more, it should not be less. Are you clear with this? Or this happens, can I say, at a point where my contribution is exactly equal to fixed cost? Guys, are you clear with this? Any problem here? Any problem here? Now, contribution is how much? So, I don't know how many units, correct? I need to calculate the units. But every time I sell a unit, I will get how much? 4 rupees. So, can I say my contribution will be number of units sold into 4 rupees? Correct, guys? Yes, is equal to 10,000. So, we are trying to find out how many units should I sell to exactly generate a contribution that is equal to 10,000 rupees. Guys, correct? Or can I say how many units should you sell? X is equal to 10,000 divided by 4. Correct? Or can I say X is equal to how many units? 2,500 units. Guys, correct? Are you clear with this? So in this case, I would say 2,500 units is the break-even point. Meaning what? Meaning what? It means that if you sell exactly 2,500 units, now your contribution will exactly recover your fixed cost, resulting in a zero profit. No positive, no negative. Are you clear with this? And hence I call this as a break-even point. Are you clear with this, guys? Are you all able to understand? Are you all able to understand? Or in other words, this break-even point is nothing but fixed cost divided by contribution per unit. Correct? No? If I want to put it as a formula, very simple, I need to earn a total contribution that is equal to my fixed costs. And every time I sell a unit, I generate a contribution per unit of 4 rupees. So how many units should I sell? Fixed cost divided by contribution per unit. Are you clear with this, guys? Are you clear with this, guys? Right? So can I say break-even point, if you want it in units, is nothing but it goes by the formula fixed cost divided by contribution per unit. Are you clear with this, guys? Are you clear with this, guys? Yes? Are you all able to understand? Yes. Now, if I want to calculate the break-even point in value, how will I do that? Once again, very simple. Now, I will make the use of PV ratio. What is it? Now, we know that the PV ratio is how much? 40 percentage. That is, if I make sale worth 100 rupees, I generate a contribution of 40 percentage, 40 rupees. Correct? Yes. Now, break even point happens at a point where my contribution is exactly equal to fixed cost. Or in other words, I should earn a contribution of how much? 10,000 rupees. Now, if 10,000 is 40 percentage, for me to earn a contribution of 10,000, how much sale should I have made? So if 10,000 is 40, how much is 100? Or in other words, if I want to calculate the break-even point in value, can I say it is nothing but fixed cost divided by PV ratio? That is 10,000, if it is 40 percentage, how much is 100 percentage? I will get it as whatever is the value. So how much is this? 25,000. Are you clear with this? Or you can also do it like this. We calculated the break-even point in units. Correct, 2,500 units. 2,500 units. Every unit has a selling price of 10 rupees. That way also you can find 25,000. You can just play around with the figures. Are you clear with this, guys? That's about this concept. Are you clear with this? Are you clear with this? So you just scribble this down. You please write this down. You please write this down. And formally, you please write this down in a blue ink itself. Black ink item, I will tell you. Black ink item, I will tell you. First, in blue ink, you scribble down all these things. Black ink item, I will dictate, I will tell you. Don't worry. The formulas, I will tell you. Logical derivation, it happens like this. Guys, are you all understanding? I don't want you guys to mug this up. Now, it's so saddening to know that many students mug this up. Please don't mug this up. If you mug this up, this chapter is gone. That's about it. Right? So please learn it conceptually. It's very, very good to learn it conceptually. All these concepts are beautiful. Right? Right? You guys have got up running notes? Done? Done? So now write down break-even point in the center and branch it into two. Branch it into two. In units, in value. Come on, guys, in units, tell me what is the formula. How will you calculate? Think and tell me. Don't mug up. Tell me. Yes. So, break-even point is equal to fixed cost divided by CPU. For our classroom discussion, we will use the word CPU. CPU means what? Contribution per unit. Logic, very simple. I need to earn a contribution that is equal to fixed cost. Every time I sell a product, I earn 4 rupees of contribution per unit. How many units should I sell to arrive at a contribution of 10,000 rupees? Fixed cost divided by contribution per unit. Clear with this, guys? Or if I want to calculate the break-even point in value, how will I do it? The same fixed cost divided by, directly put it as PV ratio. So, very simple. If you want to find the value in units, in the denominator, use contribution per unit. Right? If you want to get it in value, use PV ratio. Are you clear with this, guys? Are you clear with this? Always remember this. So, if you want the answer in units, use contribution per unit. If you want the answer in value, use your PV ratio. Are you clear with this, guys? Right? Any problem here? Any problem here? Right? Now, in this question, what was the break-even point? Come on, in this question, what is the break-even point? Write down in units. So, 10,000 rupees, please write down. Rupees 10,000 divided by, every time I sell a unit, I generate a contribution of 4 rupees. So, it's going to be 2,500 units. Or here, if I want to directly find it in value, if 10,000 rupees is 40%, how much is 100? Right? So 10,000 divided by 40, or you can write 10,000 divided by 40 percentage, or you can write 10,000 divided by 40 into 100. Both are same. See, divided by 40 percentage is nothing but, one second. Yes, this is nothing but what? This is 10,000 divided by 40 divided by 100, or this is nothing but 10,000 divided by 40 into 100 only, no? Right? So this is all one and the same. You can use all these things. Right? Fine. So how much is that? That's going to be rupees 25,000. Are you clear with this, guys? Are you clear with this, guys? Are you clear with this? So now you tell me one thing, guys. The company is exactly selling 2,500 units. Right? What will be the profit or loss? Hello? What will be the profit or loss? The profit or loss will be 0. Why? This is the break-even point. Why? If I sell 2,500 units, my contribution exactly recovers my fixed cost. Not a rupee more, not a rupee less. Are you clear with this, guys? Suppose a company sells units beyond 2,500 units. If the company makes sales beyond 2,500 units, then can I say the company makes what? The company makes profit. Suppose if the company is not even able to reach this 2500 units, so now what happens? This is a scenario where the company is making a loss. Are you clear with this, guys? Are you clear with this, guys? Yes. So now look at this. This is the reason why we bifurcate costs into variable, fixed and all. By looking at the sale volume itself, a businessman can know he's in a profit situation or not. Are you clear with this? For my business, I know I need to necessarily sell 2500 units to actually break even. If I'm operating at 2000 units, I know that I'm still at a loss scenario. I will try to push my sales. Are you clear with this? And remember, every time I sell a unit, look, it is enough if my sale price is more than my variable cost. Don't try to recover your fixed cost, because the contribution will go on towards recovery of fixed cost and then towards earning profit. So that is the reason why always what businessmen do is, when they are trying to fix the selling price, they fix the selling price. The minimum fixed price should be variable cost, right? The selling price cannot go below variable cost. If it goes below variable cost, then every time you sell, you are making a negative profit. That you can never break even at all. Clear with this? Even if I am fixing the selling price at 7 rupees, it's okay. 7 minus 6 is how much? 1. Correct? So I can sell more number of units using the volume. I can generate contribution. With that, partly I will recover fixed cost, and the balance I will be enjoying the profit for myself. Always remember, this is the reason why they say your selling price should definitely be more than your variable cost. Are you clear with this? Because only then you will be able to generate a contribution, and that contribution will over a volume, over a span of time, it will recover your fixed cost and contribute towards your profit. Are you clear with this, guys? Are you clear with this? Some people, what they do is, some businessmen in reality, they calculate the total variable cost plus total fixed cost divided by the number of units. They arrive at the total cost per unit. From that, they add a margin. Like cost sheet and all we were doing, no? Cost sheet and all we were doing, total cost per unit plus margin. Now, yes, that is one way of arriving at your profit, but I would say that a very good businessman would not do that. He will keep his variable cost as the base and add a margin to it, because if you do that, by accumulating volume, you can recover automatically your fixed cost and generate profit. So total cost plus approach is there, but variable cost plus approach will always help in the long run. This is actually from a practical scenario, I'm telling you. Clear with this, guys? Clear with this, guys? So to be very honest, now our costing and FM books and all are there, no? Right? The costing and FM books and all is there. So I told you guys, anyways, all the ebooks are available on our website for free for download and all. Now this, if you want a hard copy, since many of you guys were asking me, sir, provide this hard copy and all, because if you take a printout by yourself, it is costing much more. So this is what I do actually. So what I do is, I'm telling you openly, there is no profit and all that I do here. Very simple. For me, whatever is the printing cost, right, that is a variable cost for me, because per book only I pay, right? Similarly, apart from that, that is the only variable cost for me. And not just that, even the packing cost is there. That is also a variable cost. These two costs I calculate. Apart from that, what I do is, extra some 30-40 rupees I keep. That is to cover our shipping cost and all that. That's about it. Even after adding all these costs, it will be much lesser than your printing cost. If you print by yourself, it will be much expensive. So this is more cost effective, because I didn't go on a total cost plus approach. I just went on a variable cost plus approach, because I want to make sure that I am breaking even. So what I do is, I make sure that whatever contribution that I am generating from every book sold, that recovers towards my fixed cost. We have other fixed costs like administration and all these costs. We have the back-end tech support cost and all. These are minimum. This is how we do it. Are you clear with this? That is the reason why I am able to provide you the books at a very, a very cheaper rate than what it would have otherwise taken for you. Honestly, this is the reason. Costing has gone behind it. Are you clear with this, guys? Now, suppose even if I want to make some profit, now I can still make profit, which will be much, even if I make a profit here, right, it will be much lesser than what you guys would be incurring had you taken a printout by yourself. Even if I do that, now tell me, as compared to the external market, my price will be lesser. Guys, correct? So still people will come and buy it from me only. Yes, now more people will come and buy it from me. So by volume, I can make huge profit. Though I'm not doing it, I'm just telling you. Clear with this. Because my objective is not by selling books and all. I consider myself as a teacher, not as an author. So if I'm an author, then I can put all this copyright and I can make all the publications. That's why I say only through our lectures the learning will happen. That book is not a self-study book. It is meant only for classroom discussion along with our classroom and all these things. Clear with this, guys? Fine, that is a passing reference. I wanted to give this mainly because this is the reason why I am able to provide you at that rate. Are you clear with this, guys? Are you all able to follow this? Yes. So always remember, costing helps you. Whatever you do in your real life, you do costing in your everyday life without knowing that this is a concept in costing. Are you clear with this, guys? So now tell me break-even point. So if my actual sales is beyond my break-even point, it means that I am generating profit. If my actual sales is less than my break-even point, which means I've not started making profit, I'm in a loss scenario. At the break-even point, I neither make a profit nor a loss. Are you clear with this, guys? Is everyone able to follow this? Is everyone able to follow this? Perfect. And that's about the concept of break-even point. Clear with this, guys? So break-even point in units is fixed cost by contribution per unit. Variable and break-even point in value is fixed cost divided by PV ratio. Clear with this, guys? Yes. Shall we proceed forward further? So next one. I hope you guys have written this down. Write down. Next one. Margin of safety. Margin of safety. Margin of safety. Now, what is this? Catch up running notes. Please catch up running notes. I'm asking you to do it along with me. Now, guys, for the data given in this question, you tell me what is the actual sales made by the company. Come on, quick. Actual sales made by the company. How much is it? Units. You tell me in units. That's enough. This company has sold 6,000 units. You tell me what is the break-even point. You tell me what is the break-even point. So in this case, the break-even point is 2,500 units. Are you clear with this? Now you tell me how many units has the company sold over and above its break-even point. I'm repeating, how many units the company has sold over and above its break-even point. How many units it has sold? So 6,000 minus 2,500, you get 3,500 units it has sold over and above its break-even point. Correct, guys? And this is called as margin of safety. That is the number of units being sold over and above my break-even point is called as my margin of safety. Are you clear with this? So margin of safety means what? It is also sales only. The sales made over and above my break-even sales. Are you clear with this? So now margin of safety can also be expressed in units. It can also be expressed in value. This is also sale only, no? Guys, clear with this? Yes, are you clear with this? Guys, are you all able to follow this? Yes. Are you all able to follow this? Yes, fine. So what do you mean by margin of safety? So margin of safety refers to the sale made over and above your break-even point. Clear with this? Or in other words, can I say, margin of safety is nothing but the profit generating sale. That is, whatever contribution I earned using this 2,500 units. Yes, guys, whatever contribution I earned with this 2,500 units, it went on towards the recovery of fixed cost. Guys, correct? Yes. Now you tell me sales minus variable cost, contribution minus fixed cost gives you profit. Now in our example, just tell me the total figures. What is the total sales? 60,000. Yes, 60,000. 36,000. 24,000. Fixed cost 10,000. Profit 14,000. Correct? Yes. Now can I say this break-even point is how much? 2,500. Correct? Or in other words, the first 2,500 units I sold, that would have generated 4 rupees, no? Every unit would have generated 4 rupees. Yes, correct. Now the contribution generated by the first 2,500 units will be going to recover my fixed cost. Correct? That is the reason why exactly at 2500 units, my contribution is equal to fixed cost. Guys, correct? Hello? Yes. The contribution generated by the first 2500 units would have gone towards the recovery of my fixed cost. Hello? Yes. Now, over and above this break-even point, I've sold 3,500 units extra. Now, every rupee that I generate from this, every rupee of contribution that I generate using this margin of safety units will be nothing but 3,500 into 4. How much is it? How much? 14,000. That is nothing but your profit. Are you clear with this? Are you clear with this? So 6,000 units overall generated a contribution of how much into 4? How much is it? 24,000. So your total sale generated the total contribution. The breakup is up to the break-even point. It generated contribution that recovered your fixed costs, and beyond your break-even point, that is in your margin of safety units, went on towards contributing to your profits. Are you clear with this, guys? This is the way to understand it. Are you clear with this? Are you clear with this? So can I say my total sales is tied to my contribution? Correct? My total sales is tied to my total contribution. Break-even point is tied to my fixed cost, and margin of safety is tied towards my profit. Are you clear with this, guys? Are you clear with this? This is known as your marginal costing jodies. Marginal costing jodies. What are the marginal costing jodies? Contribution and total sales. Fixed cost and break-even point. Profit and margin of safety. Are you clear with this? I will dictate all these things once again. Do not worry, but catch up running notes here, and then once again I will do it. Very important understanding. Once we do this, now just like that we can do the first 6-7 sums. Just like that we can do. That's about it, right? Make sure that you are learning all the concepts properly well. Clear with this, guys? Clear with this, guys? Yes. Are you all able to follow this? Are you all able to follow this? Are you all able to follow this? So what is it? So my total sales is comprised of what? Break-even sales plus margin of safety. Correct? No? Yes, guys. My total sales can only have up to some units. It is called as break-even point. Right? Beyond that, it is called as margin of safety. Correct? Yes. So now this is how my sale is being composed. So up to a break-even point units, it goes on towards recovery of fixed cost, and my margin of safety units goes on to recover my profit, or in other words, my total sales goes on to give me my contribution. Are you clear with this, guys? Are you clear with this? So now margin of safety. So now guys, one more thing, let me add up here. One more thing, let me add up here. Just a minute. Okay. So now here this is 10,000. Okay. Now you tell me all these things can be expressed either as units or as values. No, guys, correct? This 2,500 break-even point in units, how much is it in value? 25,000 rupees. Can I say this is nothing but 25,000 rupees? Correct, guys? This margin of safety, 3,500 units. Can I say this is nothing but 35,000 rupees is my margin of safety in value? Guys, correct? This 6,000 units, can I express this in value? Yes, it is nothing but 60,000 rupees. 60,000. Guys, correct or not? Yes. Now, can I say this total sale and total contribution are linked together? Correct? How? 6,000 units. If I am selling 6,000 units, right? I am able to get a total contribution of how much? 24,000 rupees. Guys, how did I get this? 6,000 units into contribution per unit. Correct? No. How much is it? 4 rupees. Right? Yes, sir. Guys, yes. Or if I say my total sales is 60,000 rupees, can I say 60,000 rupees into PV ratio? What is my PV ratio? 40 percentage. That also gives me the same 24,000. Are you clear with this? So the connecting factor will either be contribution per unit or PV ratio, depending on whether it is expressed in units or in value. Are you clear with this, guys? Are you clear with this? Are you clear with this? So can I say total sale units into contribution per unit gives me contribution? Total sale value into PV ratio also gives me contribution. Are you clear with this, guys? Are you clear with this? Similarly, break-even point and fixed costs are tied once again using what? Contribution per unit or PV ratio. That is 2,500 units if I sell. Every unit generated a contribution of 4 rupees. So 2,500 into 4, 10,000 rupees. So the first 2,500 units only generated a contribution that recovers my fixed cost fully. Or in other words, I can say, if I made sales worth 25,000 rupees, which is again a break-even point expressed in value, right? PV ratio is how much? 60 percentage, 40 percentage. 40 percentage of 25,000 is also equal to 10,000 rupees. Are you clear with this? So can I say break-even point in units into contribution per unit gives me fixed cost? Guys, correct? Or break-even point in value multiplied by PV ratio gives me what? Fixed cost. Are you clear with this? Are you clear with this, guys? Are you clear with this? Yes. Similarly, I can say my margin of safety is tied to my profit. Again, using what? Contribution per unit or PV ratio, depending on whether you use units or value. So 3,500 units I have sold over and above my break-even point. Only these units generated my profit. That is, each unit generated 4 rupees of contribution. So 3,500 into 4, whatever is a contribution I generate is now my profit. Why? Because the first 2,500 units have already generated contribution to recover my fixed cost fully. So whatever contribution that each of these 3,500 units generate will go on towards my profit building. So 3,500 into 4, how much is that? 14,000. Or I can say this extra 35,000 rupees worth of sale, right, generated a PV ratio of how much? 40 percentage. 35,000 into 40 percentage. That way also I can say is how much? 14,000 rupees. Are you clear with this, guys? Are you clear with this, guys? Are you all able to understand this? Are you all able to understand this? Yes, you guys are able to understand, right? Right. So now margin of safety, can I say I can use all these formulas? Please wait, I will write down first and then you guys can write down. Margin of safety is equal to, can I say it is nothing but total sales minus break-even point? Correct, guys? Yes. Yes, you can write down this later. I'll tell you. Margin of safety is equal to total sales minus break-even point. Let's derive it. I want you guys to tell me. You guys are only going to tell me the formulas. Next up, what else can I say? What else can I say? So now we saw that margin of safety in units into contribution per unit is equal to profit. Hello, guys, margin of safety in units into contribution per unit, 3,500 into 4 is 14,000. Correct? No. Or can I say margin of safety in units is equal to profit divided by contribution per unit? Correct? No. That is nothing but for me to earn a profit of 14,000, right? I know I have earned a profit of 14,000. Every unit generates a contribution of how much? 4. I want to earn a profit of 14,000. Every unit generates a profit of 4, which means how many units should be sold over and above my break-even point? So I will say this is nothing but 14,000 divided by what? 4. So I should sell 3,500 units after my break-even point, not total sales, after my break-even point. Are you clear with this? Yes. Guys, are you able to understand? Are you able to understand this? Yes. Or I can even say this as your margin of safety in value is nothing but profit divided by PV ratio. As simple as that. Are you clear with this, guys? Are you clear with this? See how beautifully we can link all these concepts. Are you clear with this, guys? Yes. So write down in the center. Please write it down in the center. Margin of safety, branch it into 2. Branch it into 2 in units, in value. In units, once again branch it out into 2. total sale in units minus break-even point. Once again in units. Clear with this, guys? Clear with this, guys? Yes. Here it is going to be, and the other formula is profit divided by contribution per unit. Clear with this, guys? In our example, you tell me, what is the total units sold? Guys, come on. I have sold 6,000 units. I know that I'm going to break even at, come on, break even at 2,500 units, which means how many units have I sold over and above my break even point? 3,500 units. This 3,500 units is called as margin of safety. Or in other words, I can say, look, I have generated a profit of how much? 14,000, right? Every unit gave me a contribution of how much? 4 rupees. So which means I have clearly sold 3,500 units over and above my break-even point, because my profit can be generated only using my margin of safety units. Correct? No, guys? Yes, break-even units, the first 2,500 units will not even contribute 1 rupee towards my profit. It will only be recovering my fixed costs, right? And every unit that I'm selling over and above my break-even point will only go on to build my profit. Are you clear with this, guys? Are you all able to understand this? Right? Yes. Exactly in the same line. Branch it into two. Right down here. Total sale in value minus break-even point in value. And here also you have profit divided by PV ratio. So tell me, guys.
60,000.
So here is going to be 60,000 minus 20. Sorry, how much is that? Sorry, 10,000. Sorry, 25,000. Huh? Yes, minus 25,000. So how much is it? How much is it? Hello? 35,000. 35,000. So which means my margin of safety is sale worth 35,000 rupees. Clear with this, guys? So I have made sales worth 35,000 rupees over and above my break-even point. That is the meaning. Or in other words, I can say, what is my profit? 14,000. So 14,000 divided by 40 percentage. So now if this 14,000 is 40, how much is 100? We are trying to find out. That is the profit generating sale. Correct? Also known as margin of safety. Clear with this, guys? So how much is that? That's going to be 35,000. Are you clear with this, guys? Are you clear with this? Now tell me, guys, is there even a single formula that needs to be mugged up? Tell me, guys, nothing needs to be mugged up here. It's all conceptual. It's all conceptual and beautifully interlinked. Guys, clear with this, guys? Clear with this? Are you all able to understand this? Are you all able to understand this? Yes. Yes, you guys are able to follow? Yes. Now after writing this, come on, write down here on the top, put that table. We will put this marginal costing jodies. Okay, write down here. Take a red ink and write down marginal costing jodies, or I will put it as pairs, or you put it as couples. Yes, whatever siripu vera. Okay, right, guys, this is for our understanding, right? Very important, very important. This is how sums will be. They will not ask you directly sales minus variable cost and all. They will ask you to link all these things, right? Always remember, marginal costing is made up of one horizontal and one vertical. So horizontal, vertical, sales minus variable cost, contribution minus fixed cost, profit, right? Similarly here, break even point, margin of safety, total sales. Clear with this? And 3 linking buttons you have. With this, entire chapter is over. That's all. Any question they ask will be inside it. Clear with this, guys? Only and only if you understand this, you will be able to proceed in the chapter. No need to mug up my commitment. My commitment to you, I still stand by it. Not even a single formula needs to be mug up, provided you visualize the horizontal and the vertical format of our marginal costing. That too logically. So now, write down here, put it up. Put it up here. So here you have 6,000 units. That was our example, right?
Yes.
Yes. Now break even point is 2,500 units. right? So that's your break even point, and you have a margin of safety here, to the extent of 3,500 units. Now guys, always remember one thing, break even point is a point, clear with this, it's a point, that's all. Now if my sale keeps on increasing, break even point will not change, it will only increase my margin of safety. That's why I am generating profits. Clear with this, guys, clear with this. So your break even point, how do you calculate? Fixed cost divided by contribution per unit, correct? It will change, break even point can change only if there is a change in either your fixed cost or in your contribution per unit. If not, break even point will not change. If your volume increases, you will enjoy more margin of safety. Are you clear with this? Because the first 2,500 units would have already recovered your entire fixed cost. Any unit I sell over and above this is only going to be my balancing figure called as margin of safety. Margin of safety is a balancing figure. Are you clear with this? If you increase your sales, break even point will not change. Margin of safety will only increase. Are you clear with this? Have this understanding. That's why it's called as a point. It's a point. Whereas margin of safety can increase or decrease based on your actual sales. Clear with this, guys? Are you all able to understand this? Are you all able to understand this? Yes, Raghu, you are able to understand? Yes, you guys are able to follow this. Fine. Now look at this. That's about here. Now what we need to do, now this is our horizontal line. What is our vertical line? Come on. Yes, write down marginal costing income statement. Yes, sales minus variable cost gives me contribution minus fixed cost, yes, gives you profit. When I say profit, I mean what? Operating profit, EBIT and all. Clear with this, guys? So now, which ones you will collect? Which one you will connect? Yes. Okay, we can also fill in the one second. Let's fill in the figures, guys. Once again, let's fill in the figures. Write down what was the sale in our example. Okay, write down here 60,000. So what was the variable cost? 36, no? So it was 24 is the contribution minus 10,000 gives you a profit of 14,000. That's about it. Clear with this, guys? Now what and what I will connect. Now one more thing we can do. One more thing, if possible, can you write this down? One second. Okay, no problem. We'll continue it like this only, not a problem. Okay, so take a green ink. So what and what you will connect? This 24,000 rupees of contribution, who is responsible for that? Out of these three guys, who was responsible for that? Total contribution. What break even point? Total contribution, ma? Total contribution was generated from total sales, right? 6,000 units. Connect these two. Right? So my total sales is tied up with my total contribution. Guys, clear with this? Then out of this 24,000, this 24,000 is nothing but 10,000 plus 14,000, correct? The first 10,000 who recovered? Break even point. So connect these two, break even point and fixed cost. Clear with this? Connect these two. Then who generated the profit for you? Margin of safety. This 3,500 units only gave you the profit. Are you clear with this? Now take a red ink and put this into CPU stroke PVR. You know when to use CPU, when to use PVR. CPU, if it is in units, multiply with CPU. If all the top figures are in values, multiply it with PVR. So write down into CPU stroke PVR. This is not divided by, I'm saying or. Okay, into CPU stroke PVR. Guys, clear with this? You guys are clear with this? Right? Yes, guys? Yes. So come down and write. Total sales is tied to contribution, right? Line gap break even point is tied to, come on, tell and write, is tied to fixed costs. Then margin of safety is tied to profit. And what is the tying factor here? The tying factor will be contribution per unit or PV ratio. Write it down. Please write it down. Please write it down. So now with this, you can arrive at 6 formulas. You can arrive at 6 formulas, no? Total sales into contribution per unit, total sales in units into contribution per unit is equal to contribution. Correct? See, I can arrive any number of formulas. For example, let me say, so sales units into contribution per unit is equal to what? Contribution. Yes. Guys, correct? Or I can say sales in value into PVR is equal to contribution. Here I can say break even point. You need not write all these things down. Okay, don't write it, it's okay. Or if you want, you can write, but I don't think it's necessary. You just remember this, automatically all these things will come. Break even point into units into contribution per unit is equal to what? What? Fixed costs. Correct? Similarly, here you have break even point in value into PVR is equal to fixed costs. Now, can I say one more formula here? I will say that contribution per unit, can I say this is also nothing but fixed cost divided by break even point in units? Guys, this is one formula they will say, and they mug it up. You just remember this, no? Automatically all these things you can write by yourself. Why do you want to mug up? Why do you want to mug up? Spend this little extra time. That's all. That's all. Similarly, here they will say one more formula for calculating PVR. PVR has so many formulas. Remember this, jodies, you can arrive at any formula. It's nothing but fixed cost divided by break even point in value. Are you clear with this? You can arrive at hundreds of formulas, guys. All you need to remember is only this. That's about it. You need not know anything else. Automatically, you will remember all the formulas. Clear with this, guys? You just need to have some presence of mind. Clear with this. Don't mug up the formulas like this. This is definitely not the way of doing. See, just by looking at this statement, we have written all the formulas. We only wrote the formulas. You guys were only telling me the formulas. Right? Now, what is the question of mugging it up? Are you clear with this? I proved it in front of you. This is not required to mug up. Clear with this? Why I'm saying this again and again? Because I've seen students who struggle in marginal costing because they think a lot of formulas need to be mugged up. See, we have just spent about 1.5 hours. Basic, we started. With this itself, how many formulas we can build up, you see. With this itself, how many formulas you can build up, you see. Now you get that confidence, guys. There is no need to mug up anything. Now, what you do is, right, you can, after watching the session, you can write a list of all the formulas that you can derive from this. All you need to do is what? Only this one for us, right? With this, you try to build formulas and you see, you check it with the institute study material, one full page they have given, 2-3 pages, they have given all the formulas. You yourself can arrive. That's about it. Clear with this, guys? Get the confidence, right? Clear with this? Fine. So this is about your marginal costing jodies, and we have also done the margin of safety. And finally, okay, write down the last one, A, B, C, D, E, profit. Yes, sir. Profit, no? Profit. Yes, sir. Okay, profit. Yes. So profit. So what is the formula to arrive at profit? Hello? Margin of safety. Okay, right. Using margin of safety we can do. Correct. So profit, guys, profit I can say contribution minus fixed cost is profit. Guys, correct. Or I can say margin of safety units into contribution per unit is also profit. Or I can say margin of safety in value into PV ratio is also profit. Guys, clear? 3 formulas here itself we told. Are you clear with this? There is no big deal at all. There is no big deal at all. Trust me, this is the beauty of this chapter. Only if you know that horizontal and vertical statement, automatically this chapter itself is sorted. You will just see for yourself how many sums we'll be doing. In just quickly we will do it, provided you know all these things. So write down. So multiple formulas you can write down. If you want, you can just write it down here. Contribution minus fixed costs. Or one more formula. Okay, I'll put it in. Yes. Margin of safety, you want, okay, into value means into PVR. or you want to put it as margin of safety in units means, then you put it as CPU. Clear with this? All these are the same formulas only. So use the figures. 24,000 minus 10,000. 24,000 minus 10,000. How much is it? 14,000. Or margin of safety in value. How much was that? 35,000. No? Margin of safety was 35,000. In value, no? 35,000. No? Margin of safety in value? 35,000 into 40 percentage. So how much is that? The same 14,000 you get, right? And similarly here, 3,500 units into 4 rupees, that is also 14,000 rupees, correct? Now guys, profit cannot be expressed in units and all. Profit is all per unit and all. Profit is always expressed in bulk, right? Because in between this fixed cost came in, you can't express it on a per unit level. Profit needs to be expressed only in total. Clear with this, guys? See, that's about this entire chapter, guys. To be very honest, that's about this chapter. That's about this entire chapter. Yes, there are certain, so many learning objectives you gave. Everything is based on this only. If you know this, automatically the other points slowly we will be keep adding and we will be learning it. Clear with this, guys? Clear with this? Yeah. Now, that's about this. And one more thing I want to tell you. I wanted you guys to ask me. You didn't ask. Okay, let me ask this. Margin of safety, right? Sir, why are we calling this as margin of safety? So where is the safety and all coming here? Where is the word safety coming here? Very simple. Think of this like a businessman. Let's say I'm running a business. Right? Presently my sales is how much? 6,000. 6,000. I'm talking in units. Okay. You can correspondingly, you can take it for values also. 6,000 units, right? Now, what is my break-even point? 2,500. Means what? If my actual sale goes below 2,500, it means I'm in a loss-making scenario. Correct? Presently, I'm selling how many units? 6,000 units, which means I have a safety cushion of how much? 3,500 units. So presently, I have an extra safety cushion of 3,500 units. Even in a worst case scenario, my sale can drop by 3,500. It cannot drop below that. If it drops below that, then I will be incurring a loss. Clear with this? So in the next month, I am projecting that I will be selling 6,000 units, right? At the same time, if we budget, we will be exactly reaching there. Not necessary. So I know that, look, I will be selling, I am planning to sell 6,000 units. This is my expectation. So my margin of safety is 3,500 units. In a worst case scenario, it can drop by 3,500 units. If it drops up to 3,500, it will not impact me much. But if it drops beyond 3,500 units, my actual sales will fall below 2,500 and I will be in a loss-making scenario. So I call this 3,500 as a margin of safety that I have got. Are you clear with this, guys? Are you clear with this? So from my actual point, if my sale falls below the margin of safety, it means that my actual sale will enter into the break-even point zone, less than the break-even point zone, which will be a loss-making scenario for me. Are you clear with this, guys? Are you clear with this? And hence the name margin of safety. Clear with this, guys? Fine. That's about the basic concepts, guys. Fine. So first, one last time, you tell me, guys. So what is the format of marginal costing income statement? Don't see anything. Tell me. What is the format of marginal costing income statement? Sales minus variable cost gives you contribution minus fixed cost gives you profit. This profit refers to operating profit, EBIT. Clear with this, guys? Now, what is that vertical statement? What is it? So total sales is made up of break-even point and margin of safety. Break-even point is a point. Margin of safety is balancing figure. Total sales minus break-even point. Clear with this, guys? Right? And tell me, what are the marginal costing jodies? So total sales is tied to contribution. Break-even point is tied to fixed cost. Margin of safety is tied to your profit. The tying factor is going to be contribution per unit or PV ratio, depending on whether those top figures are expressed in units or in values. Clear with this, guys? Beyond this, what is there in this chapter? Right? So how will you arrive at the fixed cost? What is the formula for fixed cost? I'm sorry, break-even point. What is the formula for break-even point? Think and answer. break even point. Fixed cost divided by contribution per unit if you want it in units. If you want it in value, fixed cost divided by PV ratio. Clear with this, guys? Similarly, that is the case with your other thing also. Margin of safety. How do you arrive? So profit divided by your contribution per unit or PV ratio, as the case may be. Or if you want to arrive at the profit, margin of safety multiplied by contribution or PV ratio. Play around with this. You can play around with this. Please do not mug up. If you mug up, you cannot play around like this. Clear with this, guys? Are you getting it? This is the chart for this entire chapter that you need to remember. If possible, what I would suggest is write this neatly in a chart paper and stick it in a place where you will be seeing every day, right? Maybe in your room or in your cupboard. This particular marginal costing jodies, definitely you write this once, and along with this also you put it. Clear with this, guys? And you stick it on a chart, you stick the chart paper on your wall or in your cupboard or place wherever you see every day. Tell yourself that this is all about marginal costing. That's about it. With this, you can derive 30-40 formulas which are mentioned in your institute study material. That's about it. Clear with this, guys? Are you clear with this? Yes? Fine, guys. So now with this, I am concluding this session. Please revise this. This is going to be the backbone for this entire chapter. Without revising, please do not open the next lecture. Please revise this particular session. I will see you all in the next one. So thank you all so much and have a great day ahead.